Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and Sofi. Get your money right, all in one app. Know where to begin. It's October 23rd. It's Thursday. It's 11 a.m. on the East Coast. Dan is back. He took one of those, what do they call those, red-eye things?
Call them red eyes, guy.
Yeah.
Red eye.
You see Elizabeth Thomas there. That's a lovely Merlot, and that scarf is extraordinary. It's fantastic. It's new, and I noticed that, by the way. As I mentioned, Dan is back, but holy shit, Butters is going to be with us. I mean, I can't even.
John Butters, senior earnings analyst at FactSet. We get a preview of his work every week usually on Wednesdays, but you can have it in your email box on Friday mornings. That would be go to factset.com/something.
Senior earnings insight. That's what
there it is. Factset.com/insight/subscribe. They also actually all week long have a lot of great blogs. So we're going to go through Butters' work. We're getting into the meat of earnings season, and he's got a lot of great stuff.
All right.
On EPS.
So we got a lot to do here. So should we just jump into Elizabeth's note, because she's obviously channeling her Diane Keaton.
Hold on a second, guy. Hold on a second. We do have a lot to do, but let's.
But her note is like so prescient in terms of what's going on.
Guy, you sit back. Liz and I, we're here. We got this thing. You know what I mean? So, Liz, we've had some bouts of volatility. We've been up, we've been down. It seems like there's a bunch of headlines. There's a lot of tape bombs going on. Can it really be that every other day we get some comment out of the White House where they are conciliatory about the ability to kind of do a deal with the Chinese, then they ratchet it back up, and then they come back, and this is what's moving the market? But the interesting thing is moving the market's like 50 basis points each day. It's not like a big
I don't
move.
think that's really what's moving the market.
Okay.
I mean,
Let's hear it.
I think a couple Fridays ago that did have something to do with it, obviously, but I don't think that's what's going on here. So I have been talking about for about a month or so that I still think this rally can go on. I don't think it's over. I don't think this is like the beginning of the end, but we're going to have these intermittent breakdowns in beta because it gets so extended, and the extensions are happening faster.
All right, so explain that intermittent breaks in beta, because
so beta,
that's important.
Beta, I mean, this is, sort of investing.
You buy the index, and what gives you the outperformance?
Well, if you have a beta above 1, right, the index has a beta of 1.
Correct.
If your beta is, let's call it 1.2, that means you have more risk than the index. You have more exposure to market movement than the index. Much like duration, sort of, in bonds, you've got more exposure to interest rate risk. So it just is more sensitive. So a lot of these stocks, let's say meme stocks, even gold to some degree, just because of how much it had run up, high momentum stocks, high volatility stocks, those all have likely a higher beta than the index. And investors have bought a lot of beta. So long beta. And these extensions in beta, these extensions in risk are happening faster and faster each time. So we've got this buy the dip mentality, but we're buying it faster, and we're buying the low quality stuff, buying the non-profitable stuff. So then when we have these intermittent breakdowns, a shakeout, sometimes it takes a catalyst. Sometimes it's just that something like gold starts to sell off, the algos kick in, and it freaks people out from a sentiment perspective. And then that bleeds into everything else. We watched a stock like Beyond Meat gain, I don't even know the numbers, 300%, and then drop 160%, right? That's a breakdown in beta. So we're having that intermittently throughout this bull market. I think that will continue. I still think that we can have a rally through the end of the year. I want to close this statement on the fact that it's healthy behavior if you have a breakdown in beta, and then as people buy the dip, they buy back into a broader swath of things. So rather than just piling right back into the same old story, buy other stuff.
Except, all right, so Guy, I'd love to get your comment on this. So you buy beta, you take more risk relative to the market because you're looking to add alpha. Right. Correct. To that. So if you're like an active manager, like that's how it goes. And so, like, just to give you guys a sense, I'm looking down at my FactSet machine. NVIDIA has a beta of basically 1.9. Okay, so it's nearly double that of the S&P 500. And you'd be buying beta, taking more risk in NVIDIA because you think it's going to outperform in a meaningful way. Just because it has a higher beta, like a high beta, like that doesn't mean that it's expected to outperform in that capacity. All right. But just on the flip side of that, if I put in AT&T, okay, which, by the way, we got to talk about these telcos, guys. They're getting wiggity whacked here a little bit. So the AT&T has a beta of 0.5. So it's half the market. So that's just to give you some sort of sense of that, guy.
And at the time of year suggests that, and Liz and I talked about this, I think last week or earlier this week, that the time of the season suggests that if you're behind the curve, the only way to sort of get back to where you need to be performance-wise is to chase, and you chase in the high beta names. So it all actually makes a lot of sense without question. And, people are going to try to find things that they're not going to outperform with the S&P at this point if they've been underperforming. So they're going to have to find things that get them back to at least even with the performance of the broader market. So at a certain extent, I think that's what we're seeing here. And, Liz mentioned the gold move. And quickly, gold's a little bit back on its horse today, which makes sense. A pretty dramatic sell-off. I think we've done a good job here. But one of the things that I thought would trigger the gold to the downside, and Liz and I talked about this as well, was a broader move in the equity market where gold would not be spared. But obviously that didn't happen. So the question I sort of throw back to Liz is, could it be for the first time, maybe in a long time, that, the move in gold is a risk off things and maybe equities will follow gold instead of vice versa?
So the extension in gold is astronomical. And I would say probably even far beyond what many of the stocks had gotten extended to it at its peak. And Dan, I think you mentioned the stat. At its peak, it was like 50% above its 200-day moving average or something. So there's some research that Chris Verone from Strategas put out earlier this week. Basically, the message here too from me is I don't think you buy the dip in gold right now. I think it got so extended so quickly that Chris's research had said the last time it got this technically extended back in 2006, it started to turn back down. It went through a 25% correction before it chopped and then actually found some more upside. So of course, we're going to have a little bounce. That was a big move, right? A huge move in gold that is so far outside of what a normal drawdown would look like in a one-day move. Something's up there. And I think the speculation started to unwind. This is happening much more quickly and sooner than I thought it would. I didn't think gold would stop that fast and without any news, right? That was the strange part to me. There wasn't really any news. And to Guy's point, there wasn't a big drawdown in the rest of the equity market that made a whole lot of sense. So I would still be careful in the gold market here. I think there might be more downside to come.
Yeah. And your point is when you start to see an unwind of a very crowded trade, and this is something that, obviously we're going to get into your note, we're going to get to Butters, and you guys talk about a lot of fundamental stuff that are really important. If you're looking at stocks, you're looking at sectors, you're looking at relative to what you just mentioned with beta to the S&P 500, gold really only has momentum and technical things working for it and a lot of sentiment. And I think all of that was wrapped up in this move from that breakout at like 3,500. All right. So Liz, this is important. You also put a note out every week, Guy. So that would be Liz and Mario, and you can find their On the Money blog. You can go to sofi.com/on-the-money. And you can have it in your email box. Guy is nodding because I think he's going there right now.
So I am happy to report that I saw a proposal today from somebody on our marketing team that said, you know what, we should just have one spot for all of Liz's stuff. And maybe the URL should be as simple as sofi.com/Liz.
Dude, look, Guy, how happy would that make you?
We've actually said, we've said that before. I don't know what the hell's going on there. They're too busy paying for stadiums. They're not paying attention to the important stuff like Elizabeth.
If you've ever been to SoFi Stadium, you'll get it. This is like the best stadium that's ever existed. But I will tell you, if they do that, Guy, we can make this promise right now. We will make market call hats,
t-shirts.
The back of it say sofi.com/Liz. Those will happen, people. Bombard Liz's email box, okay? And we're going to get this going.
Yeah. Before we get to her note, hold on. Amanda, by the way, Amanda is great.
Yeah, she's doing okay.
Throw up this comment or question from Zlod, who this is actually, but this is pretty good. Merlot or Burgundy, how can Guy tell the difference? Well, Zlod, Merlot is actually a grape. Burgundy is a region in France. So there's a difference, and the Merlot grapes tend to be a little darker skinned. So that's how Swizzle can tell the difference. Back to you, Dan.
Interesting. Okay.
I'm a wealth of knowledge here.
Those darker grapes might have something to do with the Moors, that sort of thing. So So moving on, Liz's note.
Yes.
Here we are. All right. This is stock valuations versus real rates. And this is something that you have talked about in the past. You haven't talked about it recently.
Nope. We're resurrecting it though.
Okay, let's do it.
This is under the broad title of Liz Looks At, which is every note has a Liz Looks At. And this one, Guy, you love it, is Liz Looks At Relationship Problems.
By the way, stop right there. Stop right there. This is from Scott A. Amanda, by the way, Amanda's doing great. Throw this up. Watch this. Is everything okay with Liz? Lots of articles about relationship.
Wow.
Yes, Scott, everything is fine.
Okay, back to you.
Jeez.
I just really love using it because I think it's catchy, and now I got so into it. And this is a market that continues to present a lot of relationship problems. So, and it's an easy thing to understand. Anyway, Liz Looks At Relationship Problems. This is one of the most important ones. And in fact, I think this might be the one that helped me come up with the idea of relationship problems. So we're resurrecting this chart because it still has not corrected itself. And we would have at some point expected that it did correct itself. It has not. So what we're looking at here, for those of you who have not seen it before, we've got forward PEs in the blue line, and those are on a normal axis. So up means they're rising. And then the magenta line is the real 10-year treasury yield. It's inverted. So if it's moving down, that means the yield is actually moving up. I know that's a little wonky to think about, but the point here being that generally when you graph it this way, these lines should move together. So imagine, right, real yields moving down, usually supportive of valuations. Valuations move up at that same time. Over history, if you look on this chart in the past, back between 2010 and 2017, there was a really long dislocation that lasted almost 6 years, a little more than 6 years. So the fact that there's a dislocation right now doesn't mean it has to be over soon. We're only 3 years into it. Could be another 3 years for all we know. But if we just watch the pattern of behavior, the lines do come back together slowly before there's maybe something more dramatic that happens. I think that's what we're going to experience here. The big question is always which line has to move more. Do the PEs have to fall, or do the real yields have to fall? Problem being, in order for the magenta line to find that blue line, real yields would have to be almost negative by 1%. Chances of that happening, slim to none, in my opinion, unless we're in a really bad situation, recessionary situation, in which case the blue line obviously moves as well. Guy, do you have a question?
I do. I love your work, by the way. This is Guy from Morristown. There's another way that this can rectify itself. And please, if I'm wrong, correct me. But if actually earnings improved, if you were to see an acceleration of earnings, the blue line can come down in the right form. Like this actually could be the beginning of, and I'm not suggesting that's going to happen, but that is a potential, there's a potential way to sort of reconcile this through earnings growth.
Guy, you're kind of teasing John Butters there for a second. I'm just saying. You're kind of setting them up a little bit. All right. And then Liz, you say something's got to give. What's got to give?
One of them has to move. But Guy, to your point, we did that math. And I don't have the numbers exactly in front of me. Basically, what we found out is that earnings had to go up by a lot, like 13% more, I think, than what they were already growing in 2026. So that we'd have to have like a blockbuster year in earnings almost across the board in order for that line to come even close to where it is. And that would have to bring PEs down to, I guess, a normal level, which is somewhere in that 17, 18 range. I don't think the market would digest that very well. And it would also require that stock prices didn't go up with earnings as we were having this supposed blockbuster year, which is also not very plausible. So I think the more plausible scenario is that both lines do come in a little bit, maybe because of earnings growth and because real yields do fall as the Fed continues to cut rates. But I think real yields stop at about 1%, positive 1%. So they're going to stay apart for a while. And then I think the real closing will happen in a much more dramatic fashion sometime in the future with the blue line coming down. And then just to point out, in case anybody has a question about in the middle there in the magenta line where things fell really rapidly, that was the taper tantrum. So you don't necessarily want to have events like that bring the lines closer together, right? That was a dramatic fashion.
Taper tantrum.
We don't want to experience that again.
Deep cut, 2013. Remember,
cut.
They were like debating whether to taper their QE, taper.
And then we tantrumed about it.
And they tantrumed.
Yeah.
It really is amazing that those things, like, it's important to remember, it seems like every year there's some stupid freaking thing, you know what I mean, that just captivates. Like, it starts usually with the financial media, and then it just, works its way around. Retail starts to get focused on it.
So then let's go to the next chart and talk about the other piece that has to give. So Now, the math of this never works perfectly, but if you just think about theoretically what should happen, the nominal 10-year treasury yield, let's call it 4% right now, just to keep it easy, should really be inflation plus growth expectation, right? Right now, growth expectations for Q3 annualized are 3.9%. Okay. Add inflation to that. Inflation expectations right now are about 2.3%. That means that this 10-year should be above 6%, which imagine if it went above 6%.
Guy can imagine that. Guy, can you imagine that?
Right.
Well, I mean, 6%, Liz is 100% right. I mean, she's looking at it through sort of a historical lens, and there's obviously something. I don't know what's going to be the catalyst for something like that. I mean, 6% is way outside of my comfort zone. But again, I understand rates below 4% here. Everybody's sanguine about things, but what she brings up is actually relevant to what I think is going to happen on top of the debt problem. By the way, debt just surpassed $38 trillion in this country. Back to you, Liz.
Yeah, really quickly though, and I think this is important as you're doing this math here. So we've gone back, and a lot of folks are saying, are we in 97? Are we in 98? Are we in 99? GDP growth from 95 through 99 averaged at 4.5%. And if you go back and you look at where Fed funds were, and we can just say, they were well above 5% during that period. If you think about it. So here, I'm just going to pull it up right here on my FactSet. I just think that's important to remember. I mean, like, we did have Fed funds
during that period.
The 10-year, hold on, Liz. I mean, it probably was not far. I mean, is my guess, but here, I'll just do it versus. You ready? And I look at the 10-year yield. Yeah, the 10-year back in 1990, it was about 5%. And it didn't really break 5% in a meaningful way until like the early 2000s when we started, all the quantitative, we didn't call it quantitative easing back then, but we just took rates down a lot. So then the 10-year really never got below 2.5% during that period. I mean, it flashed down there a little bit. So we didn't get to ZERP until we got to the financial crisis.
Right. So the point here being something's got to give. The math doesn't need to work perfectly, but this can't persist for long periods of time. And there's really no knowing which part has to give, but either the 10-year is mispriced or growth needs to come back down. It's just not a sustainable goal. And if you think about what Besant wants, right? He wants 3% real GDP growth. He wants 3% budget deficits. And the administration generally wants the 10-year yield to come down. The math of that just isn't going to persist in perpetuity. So something has to correct itself here. I am of the mind, and we can argue about this all day long. I don't know that you guys would argue with me, but there are other people who I know will argue, and there's no saying who's right or wrong. But I am of the mind that this time is never really that different. And things will come back into their normal relationships. That's why I talk about relationship problems so much. The drivers will always be different. The details around it will always be different. Of course, AI is going to change the way that things look, but the broad concepts, I don't think are ever that different. We will still be speculative. We will still need to be corrected. The relationships at some point will come back together.
Guy, so you said something, and this is interesting. So relationship problems. I think Diane Keaton and Woody Allen had relationship problems. I thought you were saying that her scarf reminded you of Diane Keaton because she was a whimsical sort of dresser. But what you were really going with was Diane Keaton in the movie Something's Got to Give with Jack Nicholson.
Correct. And I think that's what Elizabeth was channeling as well.
We just tied it all together, though,
we
didn't we?
Oh, I think we tried.
That was pretty good.
Diane Keaton, I don't think she would have worn a scarf like this. She was really into like black and
white.
Don't
ask me about my business, Kay.
I loved her. I absolutely
loved her. Go ahead, Guy. Give me something.
Well, I mean, you can add this one time.
Just this one, and he lies to her. He just lies right to her face. And what does that mean? What did that mean to you, Guy, when you saw that? What did it tell you?
He was trying to protect her from. I mean, Michael was trying to be. He was trying to protect everybody in his odd way.
Well, but that really signaled something.
But then, if you remember, they shut the door. Remember when they shut the door on her? And that's right, the last scene. It's fantastic. And he sort of smirks at her, knowing that you want to watch an amazing scene of a movie. I don't know if Amanda can pull this. I don't know what we're capable of doing, but there's a scene in Godfather 2 when Kay is visiting her children in Lake Tahoe, and she's with the kids. She hadn't seen him in a while. Connie is there with her. That's Michael's sister.
They got to
rush her out of the house because Michael's about to come home. But she doesn't get out in time, and Michael comes home and she's at the door. Michael walks to the door. She's looking at him. Not a word is spoken. And he slams the door, and it's tremendous.
He just shuts it. And she's crying. The kids are not.
Yeah,
happy.
well, you know what? I mean, what am I going to
All
say?
right. Finally get to the end of the Godfather 2.
Please do.
Old. I will think
once
of
you're
you
60
during
years
that
old.
scene.
All right. This is
Sorry about
the
that.
time.
I mean,
This is
a little bit.
just really to wrap this up. If you want Liz's blog in your email box, you can have it. You just have to go to sofi.com/on-the-money. And let's make some noise. We want this to be sofi.com/Liz. All right. Let's bring him in.
/Liz.
He's been very patient. The man, the myth, the legend. That's John Butters. He's the senior earnings analyst at FactSet. He writes the Earnings Insight blog every Friday morning, but you can have it in your email box. You know where to go. FactSet.com/subscribe. John Butters, welcome back to the program.
Great. Thanks for having me back. Good
Come on, John. I mean, there's no enthusiasm there. Holy shit.
Pre-show, he was like,
you threw me off for a second. I thought you were going to ask me something different.
Yeah. All right, guy. Come on, let's get it going.
Well, I mean, I was just at an event the other night. It's a company called Unique, and there was a gentleman there from FactSet on the panel that I moderated. And afterwards, he came up to me, and he's sort of in hushed tones. It's almost as if he didn't want to say it too loud. And he goes, "Do you know John Butters?" I'm like, well, of course I know John Butters. He's like, holy, I mean, he used some words that I won't use here, like Elizabeth didn't want to use words before. He's like, he's an effing legend here at FactSet. I'm like, yeah, he is, bitch.
Guy was early. He was early on the John Butters train. I think he saw something. John, how long have you been at FactSet? And we're messing around, but you've been there. I've been reading, and Guy and I have said this. We've been reading your Earnings Insight blog for a year. Like, when did you start writing it?
15 years ago. So it's been a while.
Wow.
Time goes by quick.
Yeah. And Guy, we never thought we were going to get to meet the man, the myth, the legend.
No, but then we met him, and then we integrated and friendships, and we visited him in New Hampshire and his place in Michigan. It's been wonderful.
All right. So here's the deal. And this is, and we're being serious now. We've just been messing around. So John's work, I use it. I say this all the time. It's a good like Sherpa throughout earnings season. And it's also really something that helps set up my mindset a little bit, because, with earnings season, we always start with the banks, and oftentimes that might set a different tone, right? There's some of the things that are driving their earnings might be different than that's driving a lot of the stocks that are driving the performance in the S&P 500, right? So then we got Netflix, and now we have Tesla. It seems like the same stuff. And then we're going to get the meat of the Mag 7, and they all seem to report in the same sort of period. So they have the ability to kind of change the whole narrative. They have the ability to cancel themselves out, and then you have to start working on some other sectors, that sort of thing. So John, we love your work, and just give us a sense of where we are. I know that you're looking at EPS beats and the like here, and I think that's obviously a great way to frame, what we might see for the balance of Q3 earnings.
Yeah, well, I think it's important to know to kind of set up how we got into this earnings season to begin with, because we've had one of the most positive setups leading into an earnings season going back, I'd say, 4 years. So if we look at the start of the quarter, back on June 30th, we're looking for growth of 7.3%. And typically those numbers come down during the course of a quarter. However, this time around, analysts and aggregate actually raised their estimates during the quarter. And part of that was because we had a lot of positive guidance from the companies. 55 S&P 500 companies gave positive guidance. That's the highest number we've seen in 4 years. As you can see in this chart, the numbers went from 7.3 and we got up to 7.9% by the end of the quarter. And, Dan, as you alluded to, we've seen a strong performance from the bank so far and a number of other companies, even though there have been a couple of high profile misses with Tesla and with Netflix. Overall, 86% of the companies are beating estimates. That's well above the 5-year average or the 10-year average. And that's got us up to that 8.6% growth rate today. And again, if we just have a typical earnings season in terms of the performance versus estimates, we think that number will eventually finish around the 13% range. And that'd be the 4th straight quarter of double-digit growth. So again, I think the takeaway here is that normally those numbers come down during the course of the quarter. We see sort of a U shape where they come down and then companies beat. Here, it's just been a straight line up from June 30th through today.
Mm-hmm. And listen, a lot of people, as a matter of fact, we had Stephanie Link on the podcast many months ago, and she actually thought you could see something like this. She wound up being right. So there's I think people are starting to take some that's assuaging some of the concerns about valuation, as you've seen the earnings growth that are sort of at least making the valuation a little more tolerable. The problem, of course, is that you're going to have a couple slides down the road on this that I don't want to jump to, but it's really top heavy in terms of what's driving the growth. So yes, you have this 8.6%, but you mentioned 86% of the companies have beaten, but it's really continues to be a very top heavy type of thing.
Yeah. Hey, Liz, as a strategist, though, and obviously you don't have price targets for the indices and that sort of thing. But when you see, like, part of the narrative coming in, a lot of people were very skeptical that you were going to have, I think, John, your work was saying in Q4 of 2024 that we were going to see 13% year over year EPS growth in the S&P 500, and then all of a sudden you see all of the stuff about the trade war, right? Like that was building into the highs in the S&P 500 back in February. Then we saw the crescendo lower. Strategists were lowering their estimates like crazy. So in your mind, as someone who thinks about this the way a lot of strategists do, then they started tripping over each other to kind of get back to where they were. Is it more that we kind of reset expectations in that kind of, early spring period, and now we're seeing lowered expectations beating?
I think that's part of it. Well, it's interesting when you think about just what's happened with earnings estimates versus the market reaction to those earnings estimates. So even if we have lowered the bar, the market doesn't care, right? You can still meet or beat and the market might punish the stock. So the market's expectations are still pretty high. I actually would wonder the raising of estimates for this quarter. I wonder how much of that is still a hangover of the pause button that everybody hit in the first quarter. And then in the second quarter, we were still
cautious
sort of
guidance too,
exactly.
Right? Yeah.
Second quarter, we wait and see. And now this one, we're all like, okay, it's not going to be nearly as bad as we thought. We're still not totally sure what it looks like, but it's not going to be nearly as bad as we thought. So now we feel more comfortable with increased guidance and having a more positive outlook for next year.
And John, that's not something we usually see. It's some sort of really, it's like near-term reset like that. You know what I mean? Like I can't think back, Guy, can you, where you see some period where strategists, are calling for, double-digit earnings growth, and then all of a sudden it goes to mid-single digits, and then it goes back. And I think to Liz's point, that you probably had this reset. You probably saw a lot of strategists who sat on their hands a little bit to get back to those prior highs. You see management giving cautious guidance, right? Or cautiously optimistic, I guess. And now you're seeing that raise throughout the quarter, which is not something that's particularly common.
Yeah, and if you look at the end of July, was really the time frame. I think we started to see the estimates come back up, and I know we'll have a slide we'll talk about a little bit later on. But it's not just the estimates it wasn't just the estimates for Q3 that went up. We've seen future estimates for the fourth quarter into 2026 going up well. So there certainly was an inflection point, at the end or during the last earnings season, where the expectations started to go back up again. Exactly.
All right. Talk to us on some of these sectors, because this is obviously, like Guy alluded to, we know that some of this stuff is driving the train, whether it's on earnings growth for the S&P 500, but also performance in the index.
Yeah, so overall, we got 7 sectors reporting growth. Information technology is at the top again. No surprise there, 21% growth. We've talked about this sector, for multiple earnings seasons now. Very broad-based growth. All 6 industries are reporting growth. Really led by the semiconductors. Again, no surprise there. NVIDIA driving the growth, but also companies such as Micron Technology. Intel's expected to do well also, or do better than last year. They're off an easy comparison. Broadcom's expected to do well. And then really in second place, it's a little surprising, the financial sector has moved up to second place at 20%. This was a sector that coming into the earnings season, we were only looking for 11% growth. But again, we talked about the really strong performance, really across the board, the big banks, some of the insurance companies, and that growth rate has jumped up to 20% today from 11%. If you look at that sector, all 5 industries reporting double-digit growth. And then if we look at the flip side, again, energy earnings is going to be down 5%. We've also talked about this sector, multiple earnings seasons, as being the weakest sector. Oil prices, again, on average, year over year, were down 15%. There is an expectation into next year, energy earnings will finally start growing again. But again, for another quarter, we're looking for a decline. And then after energy, you got healthcare also expect to be also down about 5%. Really, a couple of the bigger companies there are dragging the earnings down. United Health Group and Pfizer are 2 of the bigger companies that are dragging earnings growth down for that sector. But again, we are starting to see that broadening out in growth outside of information and technology. Again, if you look at the next 3 sectors, financials, utilities, and materials are expected to be the top performers. So Mag 7 overall looking for 15% growth, but the other companies are looking for about 7% growth. So again, we're starting to see those growth rates start to converge a little bit more.
All right, so I'm going to go to Liz and say that something on this chart sticks out like a sore thumb, and that's the utilities. And historically, my instincts suggest utilities would be sort of middle of the pack, but yet they're third here, Liz, and it's based on this whole AI trade. So, you started, again, relationship problems. Not that this is a problem, but this is an outlier for sure.
It's an outlier, and especially going into a midterm election year, which are usually bumpy, utilities is not likely to behave like a defensive sector.
Mm-hmm.
So in a midterm election year, which is 2026, you usually see defensives lead. I have been pounding the table about healthcare. I will continue to pound the table about healthcare. Buy healthcare if you don't have any. And if you have a little bit, buy more, because the valuations are attractive and it probably will act more like a defensive in an environment like that. Plus you get the growth opportunity. Utilities, on the other hand, right now, which these are words that I never thought would come out of my mouth, but utilities right now are extended from a beta perspective. They are going to get caught up in those beta breakdowns because they are tied to the theme that has driven people to buy more beta. So as we have some of those breakdowns, you're going to also see a breakdown in the ute sector, which I think for people that own it as a defensive play is going to be a very rude awakening. I don't know how many people have bought it as a defensive play recently. I think most of the buyers have been because of the AI and power generation play, but don't discount the ability for utilities to actually be really volatile in the next few months.
Yeah, that's an interesting setup, though. This, like you said, it's not something you ever thought that you'd be saying.
Yeah.
And if you look at some of the defensives, and we'll hit some of that stuff in an environment like this, utilities is usually in that bucket, but they've acted well no matter what the market's doing. Part of that secular sort of theme. John, we're in Q3. Or Q4, excuse me. We're doing that Q3, earnings, set up here and environment, and we're not going to know how that shakes out until we're done with the earnings. And I think that's a month away, but we're already starting to focus on 2026 estimates. And that's one thing that's so much fun about Q4s, right? We kind of see what the expectations are. What are you thinking here? And is this somewhat predicated on how Q4 earnings come in and how we kind of weather, some of the tariffs and there's a handful of other things that are going on, a weakening labor market. I mean, when we think about 2026, there's a lot of stuff that makes it, I don't know, as clear as mud might what we see as far as earnings growth in 2026.
Yeah, so I think, one of the takeaways here is obviously one, analysts are expecting much higher growth as we get into 2026. And as you alluded to, Dan, we'll really need to see, the guidance somewhat probably this earnings season, probably more so next earnings season, as we'll get a lot more guidance on 2026 to see where those numbers move. But I think the one takeaway here is, one, again, higher growth expected as we move into 2026. But two, and we talked about this a little bit earlier, these numbers haven't really started to come down at all. And again, that's usually the pattern we see. Now we're about 20% through this earnings season. And if you look at Q1 and Q2 of 2026, those numbers have actually gone up a little bit. And even the Q4 number has gone up a little bit. And if you look at the early guidance, we're about 50-50. We've had 9 companies give negative guidance, 10 companies give positive guidance for Q4. Usually that's a 60-40 negative to positive split. We're at 50-50 now. So I think there's encouraging signs here that, again, similar to Q3, we haven't seen the numbers come down. But again, we obviously have a long way to go, and we'll see where these numbers move as we go through earnings season. And as we always say, important to watch the guidance, not only for next quarter, but like you said, Dan, look ahead for what companies are saying about 2026 as well, if they start to give us some early projections on what they're thinking for next year as well.
That's why we love your work. I mean, again, if you had asked me a year ago, I think Elizabeth probably would have been similar to me. I didn't think you'd see anything as nearly as robust as what your work suggests. But we've also learned the hard way that things change very quickly, especially sort of on the earnings front. And, this is, the projections here are wonderful. And I think the market, the enthusiasm is built on exactly this. But you just wonder, and I continue to wonder, John, what's going to be the what's going to derail this. But right now, it doesn't look like anything. So, here we are. You're looking out a year from now-ish, and that's pretty robust earnings growth.
Yeah. No doubt. I mean, again, there's other things as far as the labor market and some of the reasons why that's happening. I know a lot of folks want to kind of point to AI productivity, and that's probably something that really helps earnings growth. If you start to see that kick in, if companies are able, and we just saw that headline about Amazon by in 2 years, they want to, be able to automate what would be the equivalent of 700,000 jobs, right? So if you're getting, less cost, greater productivity, I mean, that's something that could be a massive tailwind to S&P for earnings like we haven't seen in a long time. But John, I'm sure that's the sort of stuff that you're going to be reporting on week over week. We really appreciate you being here. We hope to have you back really soon. Let's do a recap after we get to the end of Q3 earnings season. So thanks so much for being with us, John.
Sounds good. Thank you guys for having me on as always. Appreciate it.
All right, my man. So you guys know where to find that Earnings Insight blog. You can have it in your email box. Of course, we are going to do a preview of it every week. There it is, factset.com/insight/subscribe. Guy, we got to hit this. I think this is an interesting headline because we see a sea of green out there in the market today. So we're bouncing, and you might say, well, the S&P is only up 35 basis points, but there's a lot of green. One of the things that, and you might say in a day like this, you might see telcos down, right? Like there are just these bond proxies and this and that, whatever. But I'm seeing AT&T, Verizon, and T-Mobile, and I know that Verizon and AT&T had their earnings earlier in the week, so it must be T-Mobile did too. Here's the headline on AT&T that I think is really interesting. Okay. AT&T dips results show solid subscriber gains, but the stock dip as pricey mobile promotions weigh on revenues. Easy for me to say. Okay. So basically they're saying very promotional, right? But it helped, kind of spur gains here. And the stock is going lower. Now I look at Tesla. Let's pull up Tesla for a second. So they had these great deliveries. We know that going back a few weeks, right? But again, they were buying down rates to get people to buy their cars in front of the end of this tax credit. So I guess my question is, and I'd love to get Liz take too. I mean, if companies are being really promotional to get sales in the door, at the end of the day, that actually is not going to be good for earnings, guys.
I don't think so. And I think part of you didn't mention home builders in this, but they're doing similar stuff in terms of buying down rates and stuff. And I think that's one of the reasons home builders they have been under the pressure that they have been under. A couple other factors at work as well. But I think you're right to point it out. And right now they're trying to be promotional, but at a certain point, like a lot of these things, they have impact on earnings. You mentioned AT&T, which has had a huge run over the last 6 or 7 months. But you look at this, and to me, it's just really comes down to reversion to the mean. And AT&T at $25, having just recently traded almost $30, is the same price that it was. You can go back to 2000 if you want to do a long-term chart, and you can see, this stock has effectively gone nowhere in 25 years. So if you want to go longer term and look, you'll see it's just all reversion to the mean stuff. And if you look at the moving averages, that's exactly what happens. It just basically mirrors the 200-day moving average.
And it is a bond. I mean, just think about it. It's on average probably paid 4% or something like that a year in dividends. Liz, Guy just threw in home builders there. These are large purchases, right? And we're seeing that the folks that sell them are needing to make it more attractive for, and to buy them down or lower the prices. Yeah. What does that say to you in this environment right now?
Well, first of all, I love a sale more than anybody does. And if anything that gets me out there shopping,
we're big Maxinistas here. Isn't that what we
TJX?
That's
TJX, yeah.
Okay. Yeah. So promotional stuff.
Okay.
Good for you guys.
Okay.
Promotional stuff, particularly in the home builder space. The housing market is still frozen. I don't care how many people want to say prices are coming down. No, they're not. The growth of prices has slowed, but they're not really coming down. You can look at the chart. The line has barely moved. So home affordability is still very, very low, and home builders are now stuck with a lot of inventory that they need to unload. So that's what they did. They promoted it in order to unload it. Companies do probably work in some level of promotion into their forecasts of revenue, but they don't work in that much. And we are nearing now the holiday shopping season where we're about to be inundated with promotions. If the projections are correct in the sense that companies that are goods heavy, and I'll even put home builders in that scenario, right? They're goods heavy with homes. Companies that are goods heavy are going to have to promote a lot in this holiday shopping season in order to maintain units going out the door and to maintain a manageable level of inventory. if they're promoting so much and they're taking a hit from tariffs, we've got a margin problem, but we're not going to know about that margin problem until probably well into 2026. So that is something to watch, particularly in the holiday shopping season. The last thing I'll say though is promotions don't necessarily last forever, right? That's not something that's sustainable forever, but it can build up more activity. It can bring new buyers in the door. It can cause consumers to rotate to different stores. Maybe they were at, I don't know, something more expensive than TJ Maxx, and then they went down, whatever.
Guy's a big Abercrombie guy.
They have a positive experience.
Oh, an Abercrombie model.
They have a positive experience, and then they switch, right? So it's possible that it is successful on some levels.
What was Sweeney? Was she Abercrombie or was she the other one?
I think it was
American Eagle.
It was American
I can never
Eagle.
get those. Like, I don't know the difference.
No, I think it was American Eagle.
Yeah.
Couple things before we get out of here. There's a couple questions about energy, which I will address. And in no way is this intended to be misogynistic or sexist or anything. But if you go to the internet and look at what do they call those things? Memes.
Yeah, they call
There's
memes.
things about girl math, and I think it's some of the funniest stuff I've ever seen.
I've never heard of that.
Liz,
it's
help
not
me
even
out here.
insulting. I don't find it insulting. Girl math isn't like that girls are bad at math.
It's just the way they think about things.
Spend money.
So, for example, if something was $500 and you get it for $300,
right?
In girl math, you actually made $200. It's
all right, but
totally.
all right. So my wife, who's no longer a girl, I have to call her a woman. She does a cost per use analysis. You know what I mean? On
I do
things.
the same thing.
You do
amortize it.
That's interesting math.
And that's how I convince myself that I do deserve that coat.
Oh man,
that looks exactly like the other one.
Yeah, look at that. No, did Amanda do that? By the way, Amanda's great. This is exactly right.
It's so patronizing with all.
No, it's not. I mean, it's hysterical.
Kink. That's like been my life with two girls that are now 20 and 22.
So true,
you know what I mean? Like whatever's going on there, I see it, I feel it. And my daughters, you are seen. I just want to say that.
I tell Greg all the time, like if I thought something was going to cost $300 and then it ended up only costing $200, I'm like, you're welcome. I just saved us $100.
Right. So,
all right, Guy.
Fantastic.
Let's get to some guy math. That's not to be sexist. This is Guy and Tommy. I want to be very clear on this.
Capital G.
Right,
so
Guy,
we're asking about energy. So let's throw up.
Yeah.
Go ahead.
No, let's do it. You're the energy guy.
Throw up, not really, but let's throw up a Schlumberger chart. Now it's not called Schlumberger anymore. It's called SLB. But if you look,
your final trade last night on the fast.
It was oddly enough. But this, if you go back to sort of the spring, this obviously cascaded lower in the spring, like a lot of things. It never recovered. It's been sort of bouncing along the bottom. But you're potentially looking at a situation where you have this sort of bearish to bullish reversal. You get a close above the 200-day, which I think is, I don't know, 37-ish or something like that. Then things are going to get pretty interesting here in the SLB. It's same thing. Halliburton's going to be a very similar chart. Even if you look at some of the big integrated names, they're actually starting to trade pretty well. So there's something going on in energy. And one name that I think a couple names that we've been talking about, Marathon Petroleum has been a monster. It recently has pulled back MPC, but it's back on the horse. And even Valero, which had a huge pullback recently, is back above 170. So there's a lot going on here in the energy space. And I know Elizabeth talks about this, but I think listen, I was all wrong for the majority of the year last year in terms of waiting for energy to sort of get on its horse, but it certainly feels like something's happening here in the space.
Yeah, but really quickly before we get Liz to take on energy. So it's interesting that 200-day moving average, you see how it was like resistance, like to the penny, to the penny, to the penny. And then you see that bounce that we had a couple months ago. It is worth noting. And then there's that big uptrend off the April lows that it looks like we never got back down to it. But today's move is pretty astounding.
Yeah. So Guy, I don't remember. I think it was last year at some point. If you recall, I sent you a text message. I'm not going to say what the ticker symbols were, but I asked you this one or that one. And you gave me just a very clear answer. You sent back the ticker symbol that you preferred. I bought it in my personal account. I made like 30% on that name.
Stop it.
Yeah. So you are definitely somebody to be listened to in this space. And I would listen to most of what you say about what you should buy here. My hesitancy with energy is that even just what's happening today, right? Sanctions on Russian oil, crude is up a ton, right? The stocks, of course, are going to respond to that. I don't like buying a sector that is so dependent on geopolitical decisions, because we are right now more volatile geopolitically than maybe ever in my career. So how would you help people get comfortable?
I think that's 100% fair assessment, and not that there's a pushback, but to build upon that, you're right. Buying energy historically on geopolitical things has been foolish because these things tend to work themselves out, and then they retreat far more than they gained. Number one, but number two, I think in a world where valuations are going to start to really matter, and if we start to sort of rotate out of some of these high flying names, and people start looking for value, they're going to find it in the energy space. They're also going to find companies that are run better, whose balance sheets are probably the best they've ever been. I know I'm broad brushing it, but it's probably true across the board. And it just makes sense in terms of their ability, their margin improvement, their productivity levels are such that, again, they probably have never been historically because they've been forced to be better operators. So yes, you don't buy things on geopolitics, but I do think you buy things because the fundamentals actually line up really well. That's my pushback.
All right, we got to hit this because I think this is under the radar, and I think this is really important. So let's think about the AI trade. Supermicro, which is a server maker, right? And 8% of NVIDIA's business is from Supermicro. Okay. Supermicro, 8%. Okay. You may say, well, that's not a lot. Well, it's a lot. I mean, like, so these guys compete with Dell. So the GPUs go and all the memory and all this, other storage and everything like that go into these servers. And then they power the data centers, right? And then their customers, we know who they are, OpenAI and all that stuff. Okay. So the stock is down right now, 7-8%. Okay. And part of that is they gave guidance for the current quarter, or the quarter that ended September 30th, excuse me, that it was expected to be $6.5 billion in revenue. And they're saying it's going to be $5 billion. And they're saying that because of equipment upgrades or upgrade orders, you know what I mean, to the next gen, this and that, or whatever, it's pushing a lot of the sales into the current quarter. You do not want to hear this, okay? You do not want to hear this when you're talking about GPU pricing coming in. You're not supply constrained anymore in the GPUs. You don't hear that anymore, right? And then you hear about, well, we're going from Hopper to Blackwell to this. We know that AMD now just got massive orders, right, from OpenAI. We keep hearing that Huawei and China and the Chinese in general into these negotiations, that they are trying to wean Chinese buyers, Alibaba and Baidu and a bunch of these other guys, off of US chips. And this might be the sign, Guy, that we're not this Supermicro in particular. But I think it's important to remember when NVIDIA reported last quarter, they had a slight miss on their data center revenue. You know what I mean? So if you start piecing some of this stuff together, maybe we're starting to see a little bit of the slowdown. And if a company like NVIDIA doesn't have China, right, which was 15-16% of their sales, and we're starting to see, some sort of pressure is the ability for these companies to kind of train their models on much lower compute. That's going to hurt margins the whole way down the scale. You know what I mean? And then Supermicro is a company, I think that gross margins are half of that of Dell. They're major. So guys, that's something that you want to have your antennas up a little bit here, because it seems like right now the market's not paying attention to it, or at least investors, because I'm looking at SanDisk and Western. SanDisk up 12%, Western Digital, Seagate. Okay. These are all storage companies that go into these servers. So there's a lot of cross currents here.
Your point is well taken. You continue to read things about competition, about some companies being able to use a percentage of what NVIDIA's putting out there in terms of being able to do the same thing. I think I read something recently about Alibaba, which has been an old story, but it continues to sort of manifest itself. And, nobody, again, right now, the market's really not that focused on it, given the prices of some of these names. But all these things are anecdotal, but if you connect them together, they all have tremendous meaning, I think.
Liz, anything you want to leave us with? Anything sticking out to you? We got CPI tomorrow. What do you think of that number? We're going to have a real number.
Tomorrow.
The market going to trade off of it?
We have to have a real number because Social Security payments depend on it. So that's why we're getting it tomorrow. The expectation is that it's going to be a little warm.
You say that. And this is not political. You say that because Social Security, depends on it. We have a government that's shut down because the existing, those in power want to cut, or they want to get rid of, right, these subsidies for healthcare. Like, so think about it.
Half of them do.
Right. But my point is, the half that are going to be reporting this number, you know what I mean? You said because Social Security payments are calculated on it. If they don't care about extending your healthcare subsidies, do they really care about the Social Security and you know what I mean? The way in which, because that, by the way, that was like the third rail.
I don't think we're releasing
they wanted to come for Social Security. You remember that?
I don't think we're releasing it because everybody's agreed that we're happy with how the Social Security program works.
I know, but my point is it doesn't make it so we can trust the number. That's all I'm saying. If that's my point. You're saying.
Yeah. Okay. I mean, I don't know that we feel like we can trust a lot of numbers right now. There was some juicy stuff about ADP and the Fed yesterday. There's some sort of fight going on there.
Really?
So yeah, I mean, the data availability is a problem. The data integrity is a problem. Everything that's overlapping between, power that the government has to whatever. That's a different show.
It's a different show. I just think it'll be interesting, Guy, if the market trades off the number, because we've seen going back to last December. You remember that really hot CPI number that we had, and didn't we see big volatility in the market, that sort of thing? So
it was right after a pretty bad jobs number, though. Too. So that it was like jobs.
Are we ever going to get a jobs number again, Guy?
Well, here's the thing. Tomorrow is the only data we've gotten really since the government shut down. So it's possible that the market reacts to it. I'd be shocked, and I'm not saying that the government has their hands in it. Whatever. I'd be shocked if it came in way off of expectations, right?
Yeah.
I think everybody's expecting it to be
too much attention on it on this one.
Way too much attention. And it's right before the Fed meeting, right? We've got a Fed meeting on Wednesday. So the Fed already has this information. This isn't going to surprise them at all. I don't think that expectations are going to change a ton about what they're going to do for the rest of the year, because really we're all just looking for labor data. We're not looking for this.
Yeah. All right. Guy Adami.
Hundo P, as they say.
We have a great conversation coming out tomorrow morning with Stuart Sopp. He is the co-founder and CEO of Current. We're going to focus a little bit on what they're seeing. They bank it's not a bank, as you know, Guy, because you know that it's a neobank. They serve the everyday American. And so a lot of their customers have two jobs. So it'll be interesting to see. We keep talking about this K-shaped recovery, that sort of thing. So that's dropping. Liz is going to be back with us on the Risk Reversal podcast. That drops on Tuesday morning, which is really exciting for us. And then we have a whole host of things. Did you listen to the Danny, Vinny Porter pods that we had?
I forgot about
that. So that half of it dropped on Friday, half of it dropped on Monday. Okay. The important part, which is Liz's podcast, second episode, third season. Is that what we're doing?
Second episode should be coming next week. Yep, we're doing it every other week.
Do you know who we got? Who do we got?
I need compliance to tell me.
Okay, fair enough.
So no.
You know who would be great guests? Danny, Vinny, and Porter sometime.
Maybe.
Yeah, they would be
great
guests.
I will say this. I did just record an episode this week with a woman. Her name is Beth Pinsker. She's a reporter at Market Watch, but she just wrote a book on basically later life financial planning, which sounds so boring.
Guy? But it sounds so boring.
I learned so much in that episode. I was like, I could have talked to her for another hour.
Can I ask you a question really quickly? So my parents are 83, and they're asking me some of these questions about later life sort of financial planning.
Yep.
The risk reward of having a disproportionate sort of allocation to equities right now is not great. And and I know I don't mean to sound so dire, but a couple times in the last 25 years, we've seen the S&P 500 cut in half. So if you're 83 and you have to start taking distributions, out of retirement and stuff like that, the risk reward is not great anymore. If you're just like, another 10, 15, 20%, or there's a potential, and it's not a high probability, but that you could have it cut in half. Right. You know what I mean? Like, I don't know. So I'm going to listen to this episode. Maybe your guest has something to say about that.
It's a great episode. It is. Yeah. And one of the things that she says is that people find they're too conservative throughout their lives, and they find that they end up with more money than they thought at the end of their lives for what? Right.
Yeah.
So
you don't take it with you, do you, Guy?
That you can't take it with you when you die. That's girl math.
Some people try. I have some Italian friends, but
Guy.
But you got to think about spending it.
Guy is are you in the giving pledge or no? Like you and Buffett and Gates and stuff like that.
What do you mean? Giving pledge?
They pledge to give it all away.
I don't have anything to give away. So if I get to that point, I gotta give it away.
Great wine collection. Great wine.
Dude, can I tell you something? I'm actually looking at my wine now. I got a nice bottle the other night.
Wine collection.
What's that?
I didn't know you had a great wine collection.
Oh no, I got this. What do they call when you get an application?
Yeah, an application.
I have something called inventory. INVIN.
Oh, that's cool.
Yeah.
Yeah, and I've taken photos of each bottle of wine that I have.
Oh, that's what you do, and then it
tells you. Yeah.
Does it do guy math? Does it do some guy math?
No. It's not guy math, but it tells. Hold on, let me see if I can. I apologize. Does this? Can you? Let me just hold on. I'm turning. See, I don't know if you can see all that. See all that? That's all wine there.
There's some other stuff too.
Yeah.
No, I have the Lysol wipes.
I know.
Which I use to take the makeup off my face.
No, you don't.
Yeah, I do.
Stop.
Lysol wipes, guy?
Yeah.
Please tell me you're not doing that.
I have.
This is made for like bathroom floors.
Yeah.
Boiled linseed oil, which I drink.
So when Guy is not in our fine studio that Liz and I are here, he's literally in his workshop. He's in his workshop. He's like the guy. You're like the guy from what was that? What was the guy who was the handyman who had the TV show? It was a great
Pat Harrington in One Day at a Time.
No.
Tool Time.
Well,
that was the
Tim.
name of the show in the
His name was Tim.
Tim
something.
Guy, you remember this? We're being
I don't like that guy. This is, I don't know if you. Oh, you can't see it because it's green. This is that wire that you use for whatever.
Do you use that soap that my grandpa used to use, lava soap?
Sure.
Green, and it's like you do.
Fantastic. It has like grit in it.
Guy, do you in your shower, do you use like those SOS things as your bar of soap? You know,
it's funny you say that. Steel wool.
Steel
wool, yeah.
So when I was a kid, I'm sorry.
What was the name of the show?
Home Improvement.
Yeah. He's got another.
I promise it's my last story. I promise. Yeah. So I'm probably in high school, and my brother Greg and I, we were taking down an old basketball pole to put a new one up in our driveway. And we got it down, and I went to grab it, and it was like a piece of jagged metal, and I sliced like the whole side of my hand down, bleeding like a son of a bitch. So I went into the house, into the kitchen. I called my sister Gina, and I said, "You got to help me out here." I said, "Get the Ajax out and some steel wool." Gina
did that to you?
She's like, she almost threw up. I'm like, you gotta help me out here.
Ajax and steel wool. He just loves the pain. Guy just loves pain.
Duct tape.
He loves
Ajax is great stuff, man.
Gina looked at you and said,
I mean, a lot of people look at me quizzically.
Hey, can I ask you one last thing? And here's what we're gonna do. It's 11:56:30 right
here. You gotta go because people.
Well, let's take it to noon for 1 second. Pull up Blackstone for a second. And we've been talking. Comes out BX. And I'm looking at Apollo down 2%, Blackstone down 4%, KKR down 2%. So there's been a lot of talk about all this circular kind of investing in the AI space. And now these companies, they've done all these private credit deals where, let's say, I think Meta did one with KKR. They're putting up like $28 billion. You know, Meta's not putting that debt on their balance sheet to build out a data center. They're doing an SPV, a special purpose vehicle. So that's going in there. So it's not on balance sheet. You know, the private equity guys are putting in the. It just seems like all of a sudden, wait, we're doing all these build outs, right? It's being funded by no longer the cash flow of these companies. They've been spending 25-30% of their revenue on this. Now they can borrow the money. It goes into some opaque thing, right? Other folks are on the hook for it. All this circular stuff, the spending needs to keep being there. You know what I mean? Because they're building out the data center. If these data centers basically are not built, or they're not at, you know, they don't have folks that are using them, let's say in 2-3 years from now, you know, you have all this debt sitting in these SPV. It kind of breaks my brain a little bit. And is this one of the reasons, Liz, you think that this sector is kind of underperforming? And I don't know, you'd think that this would be a pretty decent environment for these companies.
Well, I think originally the reason the sector started underperforming was because other banks, traditional banks, became more attractive in a deregulatory environment, right? Money had flowed into private equity and private credit, and then traditional financials also became attractive. And let's be fair, some of the lending that's happening is happening from traditional banks too.
They lend to, by the way, the private credit, right? So it's interesting. They got boxed out like a JP Morgan. They're just making the loans to them. They're not getting the meaty stuff.
But like, then the money is still going to the same place, right? It's still a problem. So, I mean, I don't know how this all shakes out. We talked about this last week, and that was sort of my question to you, that what's in this house of cards, which card gets blown out that takes the whole thing down? And maybe some of the circular funding issue is rooted in the private credit market. I don't know if there's enough there, but certainly if the spending stops because the funding went away, we've got a problem. We'd have to make the transition, which people expect to happen in 2026. I don't know if it'll happen enough, but spending is going to slow down by spending growth, right? CapEx spending is going to slow down on AI in 2026. What you need to happen is the transition then to revenue growth starting to pick up. And if that starts happening, maybe we're okay for a little bit longer, but it's not happening right now.
It's not going to.
And then how do you measure, right, the definition of a bubble that some people are saying, where you've got spending far outpacing the revenue that these companies can generate? That's the definition that some are saying of a bubble. How do you even measure the revenue that they can possibly generate?
Because we're talking about tens of billions of dollars in revenue versus $1 trillion in build out so far. And they're talking about $3 trillion by 2030. And so if you don't see, listen, Microsoft, Salesforce, all these companies, they're not seeing the uptake of these products in the enterprise. You know, this is OpenAI, which is doing $13 billion in sales. It's primarily, 800 million users, a very small amount. We could kind of back into it, or actually paying $20 a month for as few are paying 20, how much is it? $2,000 a year or something like that for like the enterprise tools or whatever. Listen, we're going to be tracking this every day, Guy Adami. So we should get out of here. It is noon on the screws. Guy Adami, Liz Thomas, Dan Nathan. We'll see y'all. Thanks, everyone.